Welcome to the Ellsworth Advisors monthly update for May 2026. I'm Kelly Keenan. This is Cameron Mealy. Today we will be reviewing the latest economic numbers and then also talk about our portfolios and what has happened the last couple months and what we see happening in the next couple months moving forward. Cam, why don't you kick us off with some economic research?
Perfect, will do. Thank you, Kelly. Good morning, everybody. For context, today is May 5th, 2026. Kelly, last week, biggest news, we concluded the two-day Fed meeting on April 29th. And for most of you know, the Fed on April 29th, after their two-day policy meeting, decided to leave the target Fed funds rate at 3.5 to 3.75. This is interesting. Among the 12 Fed governors, the vote was 8-4, which was the largest dissent by the Fed since 1992. Now, what's important, those four dissenters, let's look at the reasons for the dissent. So Governor Stephen Miron voted no because he felt a quarter-point cut was in order. Now, Governor Miron has requested a quarter-point cut at every Fed meeting since he joined the Fed about 18 months ago, so that's not a surprise. What is a surprise is the other three no's. So Governor Miron voted no because he wanted a cut.
It's a given, yes, okay.
The other three no's were votes from regional presidents Beth Hammack of Cleveland, Neil Kashari of Minneapolis, and Lori Logan of Dallas. They all agreed with the hold, but they did not support the inclusion of easing bias in the statement. So not only were those three Fed governors no's, they were heck no's, meaning the Fed came out with a statement that said they are still considering in 2026 potential easing, which means cuts to the rate, where these three governors said, based on the information we're going to talk about, there's no way there should be any rate cuts. There should not at least be any intimation of pending rate cuts.
That implication being read by Wall Street and the pundits is they actually think potentially raising
We
rates.
need to raise rates, yes.
Which is they see inflation, they're worried about inflation, they want to slow things down. And let's talk about the rest of the economic numbers. We're all over the board.
We are all over the board.
War and the economy's good. In some eyes, or
obviously,
at least some of the numbers show the economy's good. Some show it's bad.
You know, a lot of us with variable rate debt love lower rates, but they're not. You can't just keep rates at zero. And as you said,
but when I filled my tank last week here in Hudson at $6.19 a gallon,
that is inflation.
Yes, I haven't seen those kind of numbers forever.
So let's talk really why the Fed has taken this stand-pat stance, and we have three governors saying we've got to be more aggressive with inflation. We'll start with GDP. On April 30th, the Bureau of Economic Analysis reported that according to its advanced estimate, GDP in the first quarter of 2026 increased at an annualized rate of 2%. The Bureau of Economic Analysis also at the same time reported that fourth quarter GDP increased at a sluggish annual rate of 0.5%. So, again, to your point, 2% GDP in the first quarter, that is the Fed's kind of target. So, at least on GDP, we're looking at not too hot, not too cold. 2%'s a very solid number. What is more concerning, though, are the inflation readings. The Producer Price Index. On April 14th, the Bureau of Labor Statistics reported that the Producer Price Index increased 0.5% in March. On a year-over-year basis, the index is up 4%. So this 4% is the highest highest annual increase since a 4.7% increase for the 12 months ending February 2023. Personal Consumption Expenditure Index. On April 30th, the Bureau of Economic Analysis reported that the Personal Consumption Expenditure Index increased 0.7% in March. For the 12 months ending March, the index is up 3.5%. So we've got inflation at 4%, we've got inflation at 3.5%. Let's look at CPI, the Consumer Price Index. On April 10th, Bureau of Labor Statistics reported the Consumer Price Index increased 0.9% in March, and on a year-over-year basis, the index is up 3.3%. So
we're not close to 2, we were in the 2s, and now we're firmly in the 3s,
and these are obviously lagging indicators. Your story about gas is very true. Prices are up. I expect inflation is going to be sticking around. Obviously, the energy complex in the war with Iran is not helping things, but
some of the oil might be baked in there, but the reality is, and we've talked about this, being below 3, I think is going to be
a challenge.
It's going to be a tough sledding for that, and that's kind of been our mindset. We'll be able to deal with it, but that also going back to the Fed, if the Fed funds is between 3.25 and 3.5, and we're at 3.5 inflation, yeah, at least you're still making money with short-term,
Yep.
savings, because that's really what, when you look at the T-bills, they're going to be, really hinged off of that inflation number.
Yeah.
So we're off of the Fed funds rate, which is tracking inflation. So we're not really losing purchasing power with cash at these levels.
At these levels, yeah. So, by and large, inflation is concerning. The economy via GDP seems to be healthy. Let's talk about employment. That's also something that's gotten a lot of headlines on April 28th. So we will get the jobs figure from the Bureau of Labor Statistics this Friday, May 8th. But on April 28th, ADP reported that for the 4 weeks ending April 11th, 2026, the U.S. private employers added on average 39,250 jobs per week. So if you look at that on a monthly basis, that would suggest that we could be seeing hiring of about 160,000 in April. That would be a strong number, but of course this is just ADP. It's a private payroll summary. It is from April 11th, so it is looking back. So we will see how that number comes out. Last piece that I will give is the Atlanta Fed's GDP Now forecast model. As of May 1st, the Atlanta Fed GDP Now forecast model is predicting second quarter GDP will increase at an annualized rate of 3.5%. So once again, very strong economic growth. But I think we're also seeing with a model like the Atlanta Fed's, it does update every time a new piece of data comes in. So a strong piece of data pulls it up, a weak piece of data pulls it down. It's interesting to note that the current Wall Street consensus estimate for the same second quarter number is 1.75%. So as we get through the second quarter, eventually the Fed and the pros, their numbers are going to converge. It'll be interesting to see if the pros have to converge up or if the Atlanta Fed converges down. But at least for the second quarter, it looks like GDP growth will continue to be strong, will be favorable.
Good. Yeah, and that's, I think we've said it before, we're kind of moving into an inflationary growth environment where we have a little bit of elevated inflation, but the economy is still growing. Obviously, with oil prices up and the U.S. being a net exporter of oil, that kind of helps our GDP.
Yeah.
So a lot of moving parts, but unemployment's still mediocre at best.
Yeah.
So we're kind of in this, it's a different environment. The war overhanging our heads with, that's all about oil right there. And we don't know when that's going to end, how quick that'll be resolved. It will be resolved. Can we handle $150 barrel oil? Probably. I mean, we're not that dependent on oil. Yeah. And our energy costs as a percentage of household consumption is such a lower percentage.
It's among the lowest in the world.
Yeah. Than what it was in the 70s, 80s, where, that definitely crushed us from an inflationary standpoint. But 2 months into the war, first month of war, we had a big pullback in the markets. Second month of war, last month we saw the S&P up 10.49%, so basically erasing all the losses from March. The NASDAQ up 15.3%, the Dow Jones up 7.24%, the Russell 2000, which is small caps, up 12.21%. International stocks, the MSCI EAFE only up 7.56%, and the emerging markets up 14.73%. That was for the month, which was a rebound month, really taking the S&P for the year now 5.7%, the NASDAQ for the year up 7.29%, the Dow up 3.81%, small caps, the Russell 2000 up 13.21%. International stocks, they rolled last year. This year, they're definitely struggling. I mean, not struggling. They're up 6.36, but definitely not. They don't have quite the dollar tailwind they had in 25. And then emerging markets still doing well at 14.61. Our portfolios year to date, or for April, our growth with income portfolio up 3.6%. Year to date, still up 8.5%. So year to date, doing great. We held up really well through March. We actually made money in March. So, April, we just didn't have that big rebound because we didn't have anything to rebound from. But in April, Caterpillar was up 26%. That's kind of a newer addition to that portfolio. Microchip Technologies up 44%, Nucor up 33%, NVIDIA up 14%. Losers in April, Nike down 16, Exxon down 9, Toyota down 6.5, J&J down 6. Year-to-date big winners, Microchip Technologies up 48%, Caterpillar up 55%. Our commodities portfolio, or hedger ETF, up 31%, and digital realty up 30%. Year-to-date, Nike still lagging, down 30% for the year. Toyota down 10% for the year, Lennar down 12, and Visa down 6. Our dividend yield portfolio, I'd say probably our most defensive portfolio. In April, up 2.5%. Year-to-date, up about 9.5%. Gainers in April, Cisco up 18%, Public Storage up 12, Altria up 10, PNC up 7. So kind of a smattering across the board of things that worked. Laggards, AT&T in April was down 10%, Chevron down 6.6, Medtronic down 6.6, J&J down 6. Year-to-date, big winners in the portfolio, Altria up 26%, Chevron up 27%, AEP up 19, and Enterprise Products up 20 for the year. Those are the pesky ones with the K1s. So
with the K1s.
it's worth. If we're going to get 20%, we'll deal with K1s.
With the K1s.
Exactly.
Yes.
Laggards year to date, Medtronic down 16%, Old Republic up or down 7.4%. Price potential. Portfolio has definitely been hot for the last 12, 18 months now. In April, up 19%. Year to date, we're up 27%. Big gainers in April, my Advanced Micro up 74%, Sanmina up 68%, Marvell Technology up 67%. We had Vertiv, which we sold. It was already up 41, or is up 30%. Replaced it with ANET, which went up 41%. So that combined position up 71% for the month. Google up 33. Laggards, Antero Resources down 7.5, Strategic Education down 5.5, which we ended up selling the other day. Year-to-date, big gainers. Once again, Vertiv up 108%, Marvell 94%, Petro Brazil up 86%, Advanced Micro up 66%, Dell up 66%, Technip, FMC up 70%. Laggards in the portfolio, Microsoft still down 16% for the year, Meta down 7.4%. So, we've had both tech and non-tech in that portfolio. It's been a good balance, and the stocks we're holding have definitely been working much better than the indexes themselves. Appreciation with income, April up 6.5%, year-to-date down, or up 6.5% for April, year-to-date we're still up 7% in there. Gainers for the month, Broadcom up 35, Lam Research up 21, Eaton Corp up 21, Amphenol up 17. Laggards, Domino's, we're giving them a little bit more rope, but we're probably not going to be in Domino's for long if they don't turn around. Down 5.4%, Kinder Morgan down 2, EOG down 3. Big gainers for the year, Lam Research up 51%, Eaton up 36, EOG up 34, Energy Transfer up 22. For the year, Thermo Fisher's been down 17, Eli Lilly down 13, Microsoft down 16. Jumping over to SMID, or small cap portfolio, good month, up 9%, year to date up 10. So we're starting to get some traction there. April gainers, Spire Therapeutics up 48%, Black Sky Technology up 41%, Eliant up 29%, Easy Corp up 29%, and Park Aerospace up 23%. Laggards for the month, Iramed down 14%. Alpha Metallurgical Resources down 7%, which has actually done pretty well for us in the past, except for last month. Supernus Pharma down 3%, Taylor Devices down 5%. Year to date, Black Sky still in the portfolio up 89%, Lincoln Education up 70%, Easy Corp up 69%, and Gorman Rupp up 59%. Right now, as of the end of the month, we'd weeded out all our losers in that portfolio. So, great month, really a good start to the year, being 4 months in, and I like where we're positioned, but expect volatility. earnings were really good, the latest earnings period, which kind of wrapped up, where a lot of, I think 80 to 85% of companies beat their expected earnings. So, that's been a good sign. So earnings are driving everything. And that's why we've had such a robust start to the year, even with the drag of the war going on.
Yeah. And I might mention real quick, Kelly, we discussed this before, but a lot of clients have brought up SpaceX and the pending IPO, have expressed interest in potentially getting involved with that. The message I've delivered to my clients are, right now, SpaceX is fully valued. Everybody knows what's going on with the business. The VCs that have invested recently are investing at full value. The company is a revolutionary company. Elon Musk is a revolutionary figure. I have no doubt that SpaceX will be a very successful organization, but what people need to remember is the market is forward-looking. The great news about SpaceX, the great things that the company can become, it's already priced in. So like most hot IPOs, I personally expect the company might pop at the IPO, but you give me 6 months, the company could be trading down 30, 40%. That's what happens a lot of times at IPOs. IPOs allow the institutional investors to get out while the retail investors are in buying. So my advice to anybody who's thinking about SpaceX is let it go public, let the news settle in, let the stock settle back down before you jump in.
That IPO is going to grab a lot of headlines. It's going to be talked about everywhere. It's been a while since we've had
a really big
name type headline IPO. SpaceX then coming down, following that at some point in the next couple of months will be OpenAI.
Yeah,
OpenAI will be coming down the road here, and there's gonna be good stories on. You got to get the IPO. It's gonna be a huge IPO. The price is gonna really pop. But go back even with Meta,
Facebook,
Google, all of them. Yeah, they're great on the opening day. They're good for about a week or so. But there's always a chance within the first 6 months to buy them a lot cheaper than we can get them off the IPO. So we've kind of looked at it. Do we want to try and jump in on it? We've decided we're going to stay away from the IPO piece, and but it's definitely going to be on our radar. We see a good pullback.
Yeah.
We'll definitely add it to the portfolios.
I mean, in summary, there's nothing out there in the public markets that isn't widely distributed. We don't have any special insight. Our clients don't have any special insight. It's probably a really good company. It's probably going to do really well, but unless you were an early investor, you're not going to reap the rewards of an IPO unless you buy the stock at the right valuation.
Yeah, so we'll
keep watching
when the valuations look better, we'll be in it. And like I said, it's not going to be at the IPO.
Yep. So with that, we hope you have a great month. We'll talk to you next month. We appreciate the trust you've placed in us as your financial advisor. If you have any questions, please do not hesitate to reach out to us. Have a great month. Thank you.
Thank you.